Greetings, it's Professor Lazarus talking about depreciation, but this unit we will talk about depreciation under the activity method, also called the units of production method. We'll use the same data, the same example that we used for the straight line method. So piggybacking on that data, under this method, the first thing we're going to calculate is the depreciation cost per unit. In this case per copy, because we are depreciating a copier. So we'll take the original cost of 11,000 minus the residual value of 1,000 and divide that by the useful life of 100,000 copies. So note again, we're going to use the useful life expressed as an output, in this case 100,000 copies, to come up with the depreciation rate per copy, which in this case works out to 10 cents per copy. Next, to calculate the depreciation expense for 2011, we're going to look at the actual number of copies we produced in 2011, and that would be 12,000 copies. So to calculate your depreciation expense for 2011, we take the 12,000 copies that we produced this year, multiply that by the 10 cents, which was the depreciation rate per copy that we had calculated in the previous step. And that gives us a depreciation expense for 2011 in the amount of $1,200. Okay, now for the year 2012, we follow the same model to calculate the depreciation expense. Look at the number of copies we have produced in 2012, and that's 15,000 copies. So we take that number and multiply that by the same depreciation rate per copy of 10 cents that we calculated earlier, and we come up with a depreciation expense of $1,500 for 2012. Note, under this method, your depreciation expense may go up or may go down from year to year depending upon the usage. When you use your copier more in a given year, your depreciation expense would be higher that year, and vice versa if your usage drops the following year. This method reflects reality much better than any of the other methods that you will be studying. Next, we'll talk about accumulated depreciation, and like before under the straight line method, the formula is the same. The accumulated depreciation is the total depreciation you have taken from the day you bought the asset till today. Today in this case would be your accumulated depreciation through the end of 2012. So your AD, I'm using AD as a short form for accumulated depreciation, your AD at the end of 2012 is your 2011 depreciation expense plus your 2012 depreciation expense. So we have 2 years of depreciation expense that we will have taken at this point. So when you combine the two numbers together, that gives us $2,700. This is our AD at the end of 2012 under this method. Next, item C, we calculate our book value. Again, the same time reference, the book value at the end of 2012. Your book value at the end of 2012 would be the original cost, 11,000, minus your accumulated depreciation through the end of 2012. And we had calculated that in item B, which is $2,700. So 11,000 original cost minus $2,700 accumulated depreciation through the end of 2012 gives you a book value of $8,300. So this is the way we do the various sets of computations under the units of production method and the activity method. So I hope you have a good appreciation and an understanding of how to calculate depreciation expense under this method as well. Again, this is Professor Lazarus saying thank you, goodbye, and as I always like to say, we accountants work our assets off.